I'm Dave Wagner, and welcome to another episode of Tidecrest Expert Series. Today, we're really fortunate to be joined by Jeff Willardson, co-founder, managing partner of Ghost Tree Partners. Jeff brings over 2 decades of experience in credit and alternative investments with a specific focus in building institutional quality portfolios. Earned his MBA from the Wharton School, holds an undergraduate degree in finance from BYU, and he's much, much better than me at golf, which we've established before the interview and on the course. And we're thrilled to have him here today, share his insights on the evolving private credit landscape. Jeff, thanks for joining us.
Great to be here, Dave. Thank you.
Yeah. So let's just start off with something really simple for you. You know, a lot of people don't know what private credit is. So if you could just start and explain a little bit about what that is and why it might fit in a client's portfolio.
Of course. Those words, we're very familiar with hearing public and hearing equity, right? Or
yes.
Even private equity. Private equity is probably the largest alternative asset class. Private credit is exactly that. So these are loans basically made to private organizations, private borrowers, private institutions that need capital and don't really have the opportunity to access it through normal public channels like a public company would. Credit can imply anything from a senior secured loan on the business or project to some subordinate types of capital. So it's lending to private organizations. It's actually an asset class that's probably been around for 30 years. And growing in size because, most notably, the banking community, those institutions that typically used to lend to the space, don't lend to the space anymore because they've been overregulated and it's very expensive for banks to actually make the loans that they used to make. So in have come private credit non-bank lenders. So Ghost Tree is a non-bank lender providing the same types of loans that banks used to do to the private market, and many institutions have gone in to fill the asset class void. We'll get into some of the stats, but it's basically a $2 or $3 trillion asset class. It's a very, very big asset class, rivaling real estate, private equity, and potentially growing quite substantially from there.
Yeah, great. Okay, good explanation to get things rolling. So you talked about market size a little bit. I know you have some slides. We'll put some of this stuff up.
Sure.
So how does private credit compare to other forms of fixed income? Maybe in characteristics, but also maybe in market size. We'll talk about both of those.
Yeah, maybe one of the best ways to think about private credit with respect to other fixed income alternatives, because it is a fixed income alternative.
Right.
So I think about it in 2 ways. It's a matrix, right? Risk and return, right? Let's talk about return first. Historically, the private credit asset class, as measured by an index covering private credit loans, has returned about 9 or 10% on average over time, right? Yep. So that is a pretty healthy return and a return premium to some of the traditional fixed income alternatives. And then I also think of risk as kind of a risk of potential loss, right? Risk of permanent impairment of capital. So when I think about private credit, one of the reasons to like private credit is because they're so structured in the loans and how we protect ourselves as lenders to these borrowers. Okay. Heavy covenants, heavy collateral, an ability to return our principal because we're connected to structurally and contractually pretty important parts of the business. And so from a risk of loss perspective, it actually is a lot healthier than some of those public indices. Got it.
Okay, great. Can you talk about a little bit of the size of the market relative to the public markets? I know we talked about, 2 to 3 trillion, I think is what you said on that private credit market. Was that correct? And
That's right.
So, and then reference that to like the public markets. I've always heard how large the public debt markets are.
Yeah, public debt market. We'll put up a slide and you guys can kind of review it. But publicly traded investment grade and high yield bonds is about $10 trillion, right? 10 trillion. Private credit is about 3. Okay. So it's probably double the size it was 5 years ago, and the addressable market for private credit is pretty big because they're basically replacing a lot of those bank lenders that are now overregulated and overstructured. And so non-bank lenders like us are stepping in to provide those loans that aren't historically available to us. So it's 2 or 3 trillion growing to probably 5 or 10 if we think about it over the next 5 or 10 years. It's probably, if you think about the asset class growth potential, probably one of the fastest growing asset classes out there, and replacing traditional fixed income. So those investors who have not historically thought about implementing private credit, it's probably a decent time to start thinking about it because the shift is happening. 10 trillion is going this way, 2 or 3 trillion is going this way. They'll meet at some point in the not too distant future.
Okay, interesting. So if you wouldn't mind taking a minute and talking a little bit about maybe a loan that we would see in a private credit portfolio that wouldn't be necessarily in some of these banks you talked about that are starting to maybe move out of that space a little bit, or maybe even a public debt type portfolio.
Yeah, it's a great question. Good example of an early loan in our portfolio was to an athletic apparel provider company that sells hats, T-shirts, sweatshirts, connected to a very large university in the United States. You would know it well.
Yeah.
And so this traditional retailer had been around for 30 plus years. They were banked historically by a regional bank that was localized to the merchant, right? Mm-hmm. So they had a long-standing traditional relationship. COVID wrecked a lot of things, but COVID certainly influenced the market for private credit. So this retailer, their top line revenue went down by 30%. Their EBITDA went from positive to negative, and the traditional bank, which had always lent them money, said we can no longer give you credit,
right,
because of the financial deterioration of the merchant, even though they've had a long history of doing so. Right,
yeah.
It's a difficult situation to lend to. We felt in this particular loan that COVID was ultimately going to lift, and students were going to come back to campus, students were going to go to games again, and so retailers like this company were going to start to sell again.
Right.
They needed money to buy inventory. Right,
sure.
The bank didn't lend them that money. And we said, okay, what assets can we attach to at the business that allow us comfort that we as lenders can be collateralized against something that the business owns? Well,
sure.
In this case, we're collateralized by the inventory, right? So our lien against the business is hats, T-shirts, sweatshirts. If we felt like we got in a tough situation, we could actually sell that inventory and recoup our principal, right?
Okay.
They owned real estate as part of the merchant, right? So they had a number of stores in these various locations that we then got equity pledges on. They had federal tax grants coming back to the business as a result of COVID and the related impacts on these businesses. But it wasn't due the company for 18 months, and so that doesn't help you buy inventory in the middle of COVID when you're going to get that lien, that tax credit coming in 18 months. We were leaned against that, right? So there's several attachment points of assets to the business that we would look at as a non-bank, private, bespoke, and customized lender that we said, okay, we can provide you a loan collateralized by these assets of the business. And if the thing doesn't go the way we think it's going to go, then we have recourse. We have an ability to get our capital back by enforcing on those things. So that's a very typical loan that a private credit lender would look at. What are the assets of the business? How connected can I get to those assets? As opposed to what are the financial metrics? Does it perfectly fit neatly into my sandbox of revenue, size, growth, industry? Those are all the things the banks care about, and the reasons they're so structured in their lending is because if you don't check all those boxes and you miss one, you're out, right? And so there's so many borrowers in the world that don't quite perfectly fit in that area.
Yeah, so it's a different way of underwriting altogether, right? Different way of underwriting the loan. So that's helpful. Thank you. Tell us a little bit about why an investor should consider private credit as part of their portfolio.
Yeah, I'd offer a couple of different data points. So if you think about private credit, like I said, it's been around for 20 plus years as an evolving and growing asset class. The income of private credit is very steady. So it has provided a pretty steady income to client portfolios. Let's say kind of 9 or 10%, right? The total return of private credit is essentially what the income of the loans produces. And so if you're charging these borrowers 9%, 10%, 11%, you can pass through that income to investors. So a 300 or 400 basis point premium to traditional fixed income instruments is a big reason why private credit is interesting. And that income holds pretty steady through cycles. We've seen it through the GFC. We saw it through COVID, right? That 9 or 10% income is pretty steady. So clients, when they allocate to private credit, can count on a pretty steady income stream, right? That's kind of attractive. We think about things a lot from a portfolio construction perspective about downside. What is your downside in allocating to private credit? From peak to trough, and we have a slide on this as well, from peak to trough, some of the other fixed income alternatives or even equity alternatives, the peak to trough during the GFC, 2007 to probably 2008 to probably 2011, private credit was down about 8% as an asset class. The peak to trough drawdown of private credit was 8%. For high yield, it was more like 40%.
Yeah.
Right. So there's significant pricing volatility in some of these fixed income parts of the portfolio that you would experience, and that's not a great feeling when investors run into market trouble and they want to see how their portfolio withstands. Private credit is one of those that the drawdown was less, and so the time to recovery was less, and so you're back to making income and compounding returns quicker than you are in some of the other asset classes. And a function of that obviously is the pricing, right? These are not subject to the same market pricing
Right.
mechanisms that high yield or municipal bonds are. And so that helps investors feel a little bit more stable in their ability to count on this as a protection of capital mechanism and an income generating piece of the portfolio.
Great. That's great. So let's talk about the risks a little bit, right? So there are obviously risks with every investment, risk return trade-off. You talked about that earlier. So give us a feel for, as an investor, eyes wide open, we're trying to do full disclosure here. We're not recommending people invest in private credit. We're trying to educate about the space. So give us a feel for how you should approach the risks that are presented by an allocation to private credit.
Yeah, so if you think about private credit, right, most of the companies that have gone public, they go public because of the main reason they're performing well and they're generally bigger, right? Private credit companies have not gone public yet because they're generally smaller. So the thought is that one of the big risks to private credit is these are generally smaller companies. Smaller companies have more volatility in earnings. Maybe they're more single product or single service focused, as opposed to multi-conglomerate businesses that have a lot of different ways to win and compete in many different markets. So that's one risk, is these are smaller companies. These are more subject to maybe market whims or pricing whims or tariff whims, the things that we've seen today.
Right.
And so that just means that you have to underwrite carefully. You have to understand what these businesses can and can't do. And so generally, I think that's probably one of the main risks. Liquidity is the second big risk, right? You can sell a municipal bond or a municipal bond fund in a matter of minutes, right? It's very easy to do. You can do it from your phone. Private credit is a bespoke market that's not traded, right? There's not a regular market for these loans that price and that trade. So if you want to sell one before maturity, somebody might provide you a bid for that loan, but you might not like the price. And so you need to think about private credit as trading return for horizon and time expectations. So whereas you might want liquidity in your fixed income portfolio daily, weekly, monthly, private credit is more like 3 to 5 years. It's not private equity. It's not 10 years, right, or 15, which is how you realize some of that long-term value in these companies that appreciate through time. Private credit is somewhere in between. The danger, I think, in private credit, and we'll talk about this probably next, in the way people access and implement it through structure, is that there are a lot of people that offer private credit in what they call liquid vehicles, liquid structures that promise quarterly or monthly liquidity. I think that's a pretty big red flag for people going into private credit. You need to think that if I'm making a loan, and the average loan term of these private loans are probably 3 years to 6 years.
Okay.
If I'm making a 3 to 6 year loan, how realistic is it for me to expect to sell that in a matter of weeks or months? Right?
Yeah,
you need to think about private credit as probably a 3 to 6 year investment experience in order to earn that extra 3 to 5% per year in return, right? So it's a give up of liquidity for return. I think those are two of the big trade-offs, I think, for private credit.
Okay, great. And then tell us what attracted you to private credit, and maybe give us a little bit of a feel for why you guys decided to found Ghost Tree.
Spent my entire career really in the alternative asset industry, right? When I think of alternative assets, it's hedge funds, it's private equity, it's private credit, it's real estate, it's infrastructure. You've talked to your clients about those various asset classes. When I think about other the reason to like alternatives is there's better return and they're mostly uncorrelated, right? That's a very attractive statistical feature to portfolio construction. They are uncorrelated to major asset classes. And so you like those assets, those alternative assets, because they just don't look like stocks or bonds, right, that are publicly traded. And when I think about, and I spend a lot of time in hedge funds, for example, hedge funds is an interesting asset class. It takes advantage of return premium that is highly competitive, highly structured, and very nuanced. It's kind of hard to think about. Take a simple example of you're buying a currency pair. You're long an onshore part of a currency and short an offshore. There might be a spread that's capturable there, but it's hard to understand. It's hard to predict when that spread might change. Right. And hedge funds do that a lot with stocks and with companies. You're long one, short one. Those arbitrages are interesting at various points in time. They're hard to predict and they're hard to control. What we like about private credit is the predictability of the asset class, right? I'm making a loan to a company that needs the money. It's very easy to understand why that loan needs to exist. When clients understand about how it fits in their portfolio, they get why I'm lending money and how I'm earning my money. I'm getting an interest rate for that risk. And so it's a consumable, understandable part of an asset class that is much more easy to predict, much more easy to control, and to understand how it's going to perform through cycles.
Sure.
Other alternative asset classes did not perform well during the GFC, for example. We've already talked about hedge funds that didn't hold up their end of the bargain in 2008 and 9. Private equity had a similar type drawdown. They recovered ultimately, but private credit just continued to kick off income because it's predictable, it's income generating. So we really were gravitated to the idea that banks are overregulated and overstructured. It's very expensive for these banks historically to continue to make the loans that they've done. That void needs to be filled. So if we can provide capital to a space that is declining for regulatory reasons, and we can offer a solution to a client that is consumable, understandable, and put it into a portfolio where they kind of understand the benefits of it. It felt like a kind of a nice way for us to pivot into private credit.
Okay, we'll wrap it up. The last question will be, you mentioned earlier, and you just referenced it, different structures. Like, well, how would somebody allocate funds to private credit? If you wanted to put it in your portfolio, how would you do that? Kind of objectively across the marketplace.
Yeah. So about, this is an interesting stat. So about 80% of all private credit lending is done by about 10 firms right now, right? So these are firms that you've heard of, very large asset managers that offer structures to access private credit. And they generally are doing private credit in one very specific way. They are making loans to businesses that generate cash flow, and they are lending as a multiple of EBITDA on that cash flow. So they're saying, a company produces a product, they're generating an EBITDA, that EBITDA can be multiplied to create an enterprise value of the firm, and then I'm going to lend them a percentage of that enterprise value that's typically like 50%. Right? It's called cash flow lending or direct lending. That's what you'll hear most synonymized with private credit. Private credit for most people equals direct lending. Right? So that's based on cash flows of the businesses, and most of these firms do that. These loans tend to be very big. These are generally $500 million to $1 billion issues. They're generally 6-year loan terms. And they structure and package those loans into a structure generally called BDCs, business development corporations. And those can be public, those can be private. Interval funds is another structure that you've probably talked to your clients about. These are generally regulated structures, regulated by the SEC, that allow them to offer private credit to the masses, private credit to most people. The caution about many of these vehicles is the liquidity, as I mentioned, right? The liquidity is often mismatched between the liquidity they're offering investors and the liquidity of the underlying loan portfolio. So that needs to be analyzed and evaluated. So I think clients need to be aware of that. And the way we and many others offer these products is just a traditional fund structure. So you have an onshore and an offshore lending vehicle. You raise capital for those vehicles, and then we take that capital and make loans and build a portfolio through that. So you have kind of regulated, structured products and then traditional fund products. And that's generally how people can access private credit. There's risk in return for each structure. And that's worth getting into at some other future point in time. But that's generally how most people think about it.
Hey, so I would want to hear a little bit about, I'm a surfer, lifelong surfer. I heard the name Ghost Tree. I had a specific reference to what I thought it was referring to up in Northern California. And we were talking a little bit about it before the show. So give us a little feel for how that name came to be.
That's right. It's actually, when you start a firm, and we started this business 4 years ago, it's actually quite difficult, more than you would think, to find the name for a firm. Most names are taken. All the mountain peaks and street names and trees are all generally taken and put into weird combinations. So the three of us that founded Ghost Tree, 2 of us are pretty big golfers and have a lifelong passion for the game. And our third partner is a huge surfer. And so if anybody's been to the central coast of California, Ghost Trees is, as you rightly point out, is a big wave surf break off of the 18th hole at Pebble Beach. So we kind of felt like it was an interesting, nod to our kind of great outdoor loves and passions. Golf, surfing, but most importantly, it was a name that wasn't taken. You can remember it, you can spell it. We didn't make up a name, and so hopefully it sticks. But when I joke with my kids about Ghost Tree, they think it's Halloween or spooky, or ghosts or some sort of, something like that. So it's a great spot in the world. It's something that we care a lot about, and most people don't appreciate it as a surf wave. And think about it more like a tree.
Well, I feel like I definitely got it right away, but like you said, it's a name that can stick, and it's easy, and it's going to work whether or not you golf or surf or are familiar with the Carmel area and Pebble Beach and all that. But anyway, we really appreciate it, and so that's great. Thanks for sharing that story.
Yeah, sure.
So in closing, thanks, Jeff, again, for taking the time. We always appreciate visiting with people that are, have really sophisticated level of insights into an area that maybe some of our viewers don't have a lot of experience with. So thank you for taking the time to come and talking to us today and sharing details about the industry, the asset class, Ghost Tree specifically. And as always, if you're watching today and you liked what you saw, please take a moment to like and subscribe, follow us on Instagram, connect with us on LinkedIn. And until next time, thank you.